As we leave behind a week that has seen jitters around a rise in borrowing costs that saw the 30-year yield in the UK hit the highest level since 1998, we've got plenty more volatility to come because we're entering a week that sees earnings season for the fourth quarter kick off in the US. And we also see the likes of China releasing a raft of data and inflation coming out of the UK and the US at a time when everyone's growing fearful of those two countries seeing a resurgence in terms of inflation pressures. So certainly plenty of things to sink our teeth into as we look ahead to the week starting Monday, the 13th of January. So here's a breakdown for the big ticket items according to Trading Economics for the week ahead. And really things kickstart properly on Wednesday with that UK inflation report. I've included just the CPI here, but we've also, of course, got the PPI and the RPI to look out for. That same day sees the US inflation coming out later in the day. So CPI out of the US also released on Wednesday. So that's really going to be the main focus. We do see a raft of data over the course of the week for the UK with GDP on Thursday and then retail sales on Friday. And then on the back end of the week, we also see a batch of data coming out of China, of course, coming at a key time because we're now just over a week away from Donald Trump taking office. And there's, of course, fears around what that might mean for key trading partners, most notably China. And that's where we're going to kick off with that Friday batch of data giving insights for the likes of the house prices, GDP for the fourth quarter, industrial production, retail sales, fixed asset investment, unemployment. So data across the board. Of course, key to this will be the GDP figure. That fourth quarter number expected to rise quite significantly up to 1.6% from 0.9. That would provide a potential move to 5% on the year-on-year GDP figure. So hitting that 5% target would be notable if that's what's happening. And there's certainly that move to 1.6 from 0.9 would be significant. You can see it here, that last figure coming in at 0.9. Prior to that, it was at 0.5. So certainly we've been below trend for some time now. If you look at the pre-pandemic range in terms of the quarterly figures, which is this orange section in the middle, the pre-pandemic area was sort of 1.7 to 2% per quarter. This time around, we're expecting to see 1.6. So certainly a move back towards the norm. Whether this comes to fruition remains to be seen, but certainly we have seen a period recently where the PBOC and the government have been trying to provide more supportive measures, whether it means cuts to key interest rates or reserve requirement ratios for banks, whether it's easing restrictions in terms of who can buy properties where, a whole raft of different measures with the key desire to essentially drive up growth. And certainly the expectations here point towards the possibility that that has happened. Whether it happens remains to be seen. And certainly we've recently seen the inflation data coming out of the Chinese region, 0.1 on the CPI figure. We saw an uptick in terms of PPI, but factory orders or factory prices under PPI have been in negative territory, so in deflation territory for something like 26 months now. So certainly things aren't necessarily all hunky-dory, and that's why we'll be also keeping a close eye out on for some of these other figures, right? Retail sales are expected to tick higher, up to 3.2%. Industrial production, again, tick higher. House price index, well, that's expected to remain in the doldrums, essentially. Unemployment expected to remain as is. So by and large, markets expecting a relatively positive report this time around. And certainly, if we're going to be talking about a market to cover, it's got to be the US dollar against the Chinese yuan. And that's because we've seen such significant selling pressure for this pair as we head into Donald Trump taking power, but also the possibility of them sort of reacting to Trump coming into power and potentially laying on a bunch of tariffs. There's a good chance that we see them respond by essentially coming out with greater details in terms of stimulus, whether it's fiscal stimulus or monetary stimulus, and then the possibility of retaliatory measures coming out of China. Now, key to it is the idea that, the US can essentially raise the price of Chinese imports by enacting tariffs. But one way that the Chinese can counteract that is by devaluing their currency. A weaker yuan means that it makes their products more competitive and US products and imports less competitive. So in actual fact, for a country that does provide the basis for the direction of its currency, it guides the fix for the currency, there is the potential basis for further upside. Now, of course, this is the weekly time frame. We've seen such significant gains since the lows in September. Q4 was pretty much every single week seeing this pair rising. And why I've got it on the weekly time frame is that we've now rallied into this massive area of resistance where we've got the peak here from October 2022. We've got the peak from September 2023. That's where we tagged last week. And this week we have been seeing a bit of selling pressure. So the question mark here is, are we going to see the bears come back into play at this key resistance level? I wouldn't necessarily say that we've seen that signal quite yet. You can see here in terms of the upward trajectory has faltered somewhat, but unless we break back down below this near-term swing low at 7313, then near-term pullbacks, there's a good chance that we could see the bulls sort of buy into them once again. From a fib perspective, we'd be looking at levels like, let's just get 61.8 as well, so 7.3315, 7.3245, that kind of zone if we come into this deeper pullback. But certainly if we were to see some strengthening in terms of the growth picture, the economic picture for the region, then possibly you do see further strength for Chinese yuan, so weakness for this pair, and certainly that would be notable given the resistance level that we're currently trading into and respecting. But certainly this is going to be a key one to watch because there is the sort of basis for potential further weakening for the Chinese yuan going forward, depending on how trade relations shape up between the US and China. And so a break up through this 7.375 peak would be really notable and potentially pave the way for a continuation of this long-term trend, which has generally favored the US dollar over the Chinese yuan. Next up, let's look at the US area, and we can see it right here. So US has got a number of key reports over the course of the week. PPI on Monday, CPI on Wednesday. Thursday, we've got retail sales, the jobless claims, the Philly Fed, and industrial production. Bear in mind, I'm recording this video prior to the US jobs report, so we're probably going to see some volatility off the back of that as well, depending how things land. But certainly what we have seen recently, and we've heard it from the FOMC with their latest minutes, is that they are fearful and markets are fearful that we're going to see a resurgence in inflation, that the risk is tilted towards the upside, as they say in Fed speaking or central bank speak. And that's because Donald Trump's coming in. He promises to spend more. He promises to raise tariffs around the world, and therefore there'll be importing inflation. And so there is risk that comes with Donald Trump, despite the fact that it also comes with the possibility of economic outperformance with this US-centric approach and growth-focused approach. So at the moment, there's this sort of weighing up, for equity markets, weighing up between, do we feel optimistic that, everything's going to be great under Trump because he cares so much about what the equity markets are doing every day and cares so much about growth. Whereas that overlaid with the fact that ultimately you're not going to get much help from the Federal Reserve if your pro-growth strategies push inflation higher once again. And for that reason, inflation remains absolutely key at the moment. As I always highlight, the monthly inflation data is more important than the yearly. The yearly is the number that ultimately everyone looks at to say, are we in the right place? But if you're looking at the inflation data as it comes out, because we already know the kind of area that we're on in terms of the year on year, the key thing is, are we moving in the right direction over the near term? And the near term is the last month, right? Not the way that things are working out in terms of base effects, because that's something that we can sort of look at separately. So core inflation expected to remain at 0.3 and monthly headline inflation expected to move up to 0.4. Of course, remember, we want to be at 2% or below, 0.2 or below for us to hit target, right? To hit that 2% target. And also bear in mind, the Federal Reserve generally, if they're looking for core data, they're looking for the core PCE figure rather than the core headline inflation figure. So the fact that, core month on month is expected as 0.3, but headline is expected as 0.4, that's a bit concerning. Now, I'll provide a more detailed breakdown of this on Monday. I'll make a separate video giving you a sort of deep dive into all of the different metrics around it. But because the week ahead, I'm covering 3 different topics, I generally just stick to sort of 1 or 2 charts to go alongside it. So let's just look at the breakdown for headline versus core CPI, right? So core is blue, headline is green. And so we're essentially looking to see, what's the trend at the moment? Well, what we can see in the middle part of this chart is the month of months, right? So what we saw was the beginning of the year of 2024 saw January, February, March in particular, but also April, providing really strong inflation on a monthly basis. That dropped off heavily in May, June, and to an extent July, but July was the beginning of a phase where things started to pick up. And since then, we've been moving higher and posting relatively strong monthly figures. In actual fact, the weakness of the energy markets keeping those monthly figures for headline relatively low and the core figures being relatively high in comparison. But certainly over the past few months, things have been moving in the wrong direction. And so, are we going to see a continuation of that? Well, certainly if we were to see a 0.4 figure, then again, that pushes higher yet because 0.3 was the last monthly figure. So that points towards the past, 5 months, 6 months as a sort of reacceleration of that growth in terms of inflation. It's not ideal. The caveat to this is if we're looking at the bottom section of this, that those sort of weak numbers in May and June in particular, and the fact that headline inflation throughout July, August, and September were pretty much where we need them to be. That means that if you look at the past 7 months, so once the April figures stripped out, where would we be at the moment? Well, that would put us on track to move below target at 1.78. Of course, I'm not covering the core PCE metric here. So that could provide the basis in the mid part of 2025 to feel pretty confident within the decision to cut rates further from the Federal Reserve. Of course, there's question marks about whether the Donald Trump coming in will provide the basis for higher inflation, and in which case, then we might be in a very different position. But as things stand, if the past 7 months, the average of the past 7 months is replicated for the next, what we're looking at, 1, 2, 3, okay, well, it's 5 months. So for the next 5 months, by the end of that, we're going to be below target at 1.76. So we have got a whole load of pretty solid historical figures for us to move out of the equation with so-called base effects, seeing those monthly numbers dropping out and replaced with what we're seeing over the near term. Now, the problem is that we're seeing energy prices rise. We're expecting to see 0.4 on that monthly figure. So there's a good chance that unless they keep a lid on that, there's a good chance that we do see stronger figures over the monthly numbers over the months to come. And in which case, then those fears will continue to persist. Now, bear in mind, we have been talking a lot recently about bond yields, and a lot of that comes down to expectations in terms of inflation and expectations in terms of monetary policy. Here's the outlook according to the Icon platform from the London Stock Exchange Group. And we can see here that as things stand, January, we're expecting no change, 61% chance of no change in March. And then essentially it's a coin toss for May. So markets are pricing the next potential rate cut as coming in May, but more likely in June, where they have a 70% chance of a rate cut attributed to it. That's just for a 25 basis point cut. But like I said, by June, I think there's a good chance that we move back down to target, right? Depending on how things play out with Trump. But the current trajectory points towards us hitting target in June. And in which case, maybe we see things easing off from there. So markets are then looking beyond June to say, we're probably going to see another rate cut by year end. It's a bit of a coin toss though, and that would be probably in December, and it's pretty much a 50-50 split. So markets aren't necessarily in a position where they feel super confident that we're going to be seeing a raft of rate cuts. And so numbers such as this coming CPI figure will really need to stay relatively low on a monthly basis for us to gain confidence that we continue to move in a trajectory that's going to take us back down to target by the middle part of 2025. Now, like I said, we have been seeing significant upside in terms of bond yields, and that's certainly been grabbing the headlines of late. Let's just bring up the chart here, and we're going to be talking about the Russell 2000, because Russell 2000 is particularly notable at a time where you're seeing a rise in terms of borrowing costs. So higher interest rates and higher rate expectations provide higher bond yields. Higher bond yields raise borrowing costs. Higher borrowing costs are detrimental to stocks within an index, where you are looking at a number of companies that are indebted or taking on debt. Then we're not talking about, your big tech. So big tech at a time where you're seeing higher bond yields or higher borrowing costs, okay, you could say that some people would look towards it and say, well, I can get a risk-free return that's high, relatively high from the Fed, and the government's not going to fold, and that might dampen some demand for equities as a whole. And of course, the most in demand equities are those big tech names. But certainly it's the Russell 2000. I think as you see higher bond yields, you're likely to see some weakness there because of the risk around what's going to happen in terms of their sort of position financially if borrowing costs soar. The other side of it is also we're going to be looking out for what Donald Trump does, because of course this sort of America first approach should be good for companies that are relatively domestically focused and less international in basis, and therefore the Russell 2000 with the smaller companies and the growing companies would be exactly that. So that's another element to be looking at. You can see the 61.8 support level is here. We've also got this ascending trend line. So we've got an interesting area that has been sort of holding up as consolidation at the moment. There's a good chance that we do, though, certainly if bond yields were to continue to move higher. This sort of move here doesn't necessarily fill you with a huge amount of confidence. You'd certainly feel better if it was moving like that. But at the moment, it looks almost like a sort of flag formation before the bears come back into play, quite frankly. And so key to this will be whether we hold up around this near-term swing low that you can see down here, which is your first low, 2202. And certainly if we look at the hourly time frame, let's just get rid of these lines that's not going to help. Let's just get rid of some of these lines so clear it up a bit. But you can see here that the recent trajectory has been coming into some really deep retracements, so much so that they will be beyond the 76.4. So as you can see, they're well beyond the 76.4, and the next move is akin to that. So we're sort of on relatively icy ground at the moment, I would say, with these very deep retracements. We're barely making any ground when it comes to a recovery in the Russell 2000. And that, in my mind, is because of this rise that we have been seeing in terms of borrowing costs with US 10-year yields and 30-year, you name it, all moving towards the upside. So not necessarily a great environment for the Russell 2000. And that's why I'm talking about it, because let's say we see a relatively hot inflation figure coming out, the Russell 2000 is likely to get hit, bond yields likely to move towards the upside. Conversely, if we saw a relatively low inflation figure, particularly on that monthly number, which I'm going to be following, then we could see a bit of a pop, and this trend line support and Fibonacci support starts to come into play once again. So a really interesting market to be watching at the moment. And then finally, let's look at things in terms of the UK. UK also has been struggling when it comes to borrowing costs. We've got inflation data coming out on Wednesday. Also, Thursday, GDP, both year on year and month on month, industrial production, manufacturing production, balance of trade. We've got retail sales. We've also got a 10-year Treasury gilt auction on Wednesday. So it'll be very interesting to see how that goes off. So plenty to sink our teeth into. Also, key to it is the fact that over in the US, people can say, well, CPI is doing this or that, but what's the core PCE number doing? Because that's what the Fed care about. Well, the UK doesn't necessarily have that same approach. So this CPI report should tell you everything you need to know, really. And certainly, the UK is in a fairly curious position, because whilst the US is seeing higher borrowing costs because we might see less rate cuts, and that has a basis in economic strength and that providing potential inflation. In the UK, you do have some fears of a resurgence in terms of inflation, in part because we could import inflation from the US. If we see higher US inflation, we have a balance of trade deficit when it comes to goods with the US, and therefore you could see those higher priced goods imported, and therefore we'd import inflation. But we've also got some fears around potential inflation off the back of some of the policy measures enacted by the Labour government recently. They raised minimum wages. They decided to raise the national insurance rate on businesses. So essentially, they're raising costs for businesses, and they can take two different approaches. They can hire less people, or they can raise their prices so that they maintain their margins. And that, of course, is inflationary by nature. So people were very fearful that those policies could be inflationary and potential inflation coming from over in the US. And that's why this is going to be really key to watch out for. Are we going to see further upside in terms of UK inflation? Well, I would say that UK looks in relatively decent shape, quite frankly. There has certainly been some fear recently because, as we see on the top end of this chart, UK year-on-year inflation is well above target when it comes to core. That's 3.5. And then the headline numbers pushed back up. It did head back down to target already, and then it's moved upwards, now 2.62. But we can look at things on a different or from a different perspective. And that's because we can sort of break it down as we always do. So let's look at how things are going to shape up. We're just waiting for the December numbers to come in. We've already got, in terms of both core and headline, some pretty chunky numbers from last year around. You can see on the left-hand side in the middle of the chart, both figures sort of the core figure is above 0.5, the other one sort of more like 0.4. So relatively strong numbers dropping out. That should provide some disinflation for the year-on-year figure. Now, January is probably going to be a bit of a shock because January we see this massive negative figure stripping out, and so there's a good chance we see upside for inflation that time around. But from then onwards, you can see February, March, April, really strong disinflation expected as we see those base effects really dominate. And if we look at the bottom of this, we can see the 6-month annualized pointing towards, in 6 months' time, where will we be given the trajectory that we've seen over the past 6 months? And that points towards headline inflation being at 1.83 and core inflation being at 2.45. So there's a good chance that in the midway part of 2025, we've essentially brought inflation under control. Of course, there's caveats. What are businesses going to do in relation to the policies from the Labour Party when it comes to, like I said, minimum wages and national insurance? And also, are we going to import inflation from the US? Certainly, these elements are going to be absolutely key as we move forward. And if we're looking for market perceptions over the direction of travel, like I said, it's the bond yields that you're going to want to look out for within that. Now, in terms of a market to watch, I thought an interesting one here would be euro sterling, because what we have seen over the course of this week in particular is a pop. So we're seeing weakness in terms of the pound, despite that sort of sharp move higher in terms of yields. And that sort of goes to show that yields, sort of higher yields, don't always benefit the currency. Certainly on this occasion, it's not benefiting the currency because it's coming out of a position of relative fear rather than the position of relative strength over in the US. But this does point to or bring us into a curious position where we're now back up into the 76.4 fib, set within a very clear long-standing downtrend here. We are expecting to see a significant amount of rate cuts from the eurozone, from the ECB, compared to the Bank of England in the year ahead. And so certainly there's a good chance we do start to roll over from here. You can see that long upper shadow taking shape on Thursday, a bit of indecision here on Friday. So a break up through trendline resistance and 0.84487 starts to point towards a potential bullish breakout from here. But until that happens, this pop, to me, I think there's a good chance we do start to see some selling pressure coming into it. And certainly when we're looking at this inflation report, it's going to be really key as we move forward. So I hope that's been useful for you guys. Plenty to sink our teeth into. Like I said, I'm going to provide a preview for both the US and the UK inflation on Monday with a sort of deeper dive into more charts aside from just this. And yeah, good luck for the week ahead. Like I said, we've also got earnings season, which has kicked off, and I provided a video for that, taking a look at United Health alongside Goldman Sachs and JP Morgan. as the big banks kick things off. So I've given you a sort of wider overview for the sort of sector specific outlook for the earnings season as a whole, and then a look into those sort of financials. So that's another thing that you should be watching after this. Make sure to like, subscribe, and follow the channel for much more like this. Have a great day and have a good weekend, everyone. Thanks a lot.